Alibaba's e-commerce platforms, Tencent's video games, DIDI'S ride-hailing service. These are some of China's biggest names in tech, and for the past several years, foreign investors have been pouring money into their stocks. But this summer, those shares listed in New York and Hong Kong saw sharp sell-offs, and it had little to do with their business performance. China has taken a series of actions against big tech, and those moves, from clamping down on alleged monopolistic behavior to tightening rules on data security, have sent shockwaves through international markets.
There has been a sense amongst Chinese officials that some of these companies have become a bit too powerful.
In July alone, food delivery app Meituan, Tencent, Alibaba, and short video app Kuaishou lost about 20% of their combined market value. A top Chinese securities regulator privately reassured foreign financial firms that the government would consider the market impact of its policy decisions. But investors wonder what the future holds for China's tech companies and, more broadly, for listings of Chinese companies in the US and other countries.
The scope and severity of the moves recently has taken people aback. Many foreign investors are kind of asking, okay, we thought we knew all the risks here, but are things actually worse than we imagined?
China has stepped up efforts to rein in big tech, and fast-growing firms like Tencent and ride-hailing app Didi, which have become central to everyday life in China, have been subject to the clampdown.
In many ways, Didi is the Uber of China.
Earlier this year, Didi went public on the New York Stock Exchange in a multi-billion-dollar IPO that was completed in just a few days.
It emerged that perhaps they hadn't got the full sign-off from the Chinese authorities, or at least the Chinese authorities had suggested to them they might want to hold off, partly for kind of data security reasons, but Didi pressed ahead.
China's regulators launched a cybersecurity probe and suspended Didi's apps and said the company, which collects a range of user data, hadn't complied with China's data protection rules. Shortly after, its stock plummeted.
It kind of left investors with the sense that Didi had been punished for having the temerity to go public when it should perhaps have been more heedful of what Chinese regulators were saying.
Didi said it would comply with requirements made by relevant authorities. Last year, after billionaire Jack Ma publicly called for regulatory changes, Chinese authorities targeted Ant and Alibaba, two firms he's closely associated with. Regulators shut down Ant's blockbuster IPO, which was expected to be the world's largest public listing, and launched an antitrust probe into Alibaba. Now, after all these events, markets are jittery. In August, when a state-owned Chinese newspaper criticized online gaming as opium for the mind, the stock of gaming giant Tencent saw a massive sell-off. Tencent, also the owner of social media and messaging platform WeChat, has recently come under pressure to address what authorities are calling anti-competitive practices and security issues. Tencent said it would introduce new rules including stricter curbs on younger gamers. Some investors wonder if Chinese authorities might also target the mechanism foreign buyers use to invest in Chinese stocks listed offshore. If you're investing in certain US-listed Chinese companies like Alibaba, you're not exactly buying shares directly in the business. You're buying into an offshore vehicle that has a series of legal arrangements with the operations inside China. This setup uses what is known as a VIE, or variable interest entity.
There are literally trillions of dollars worth in market cap of Chinese companies listed abroad, and most of that is done through these VIE structures. Over time, some people have questioned, because it operates in this kind of grey area, whether the Chinese authorities might one day kind of decide that they don't like this loophole.
Until recently, Chinese companies going public in the US were a bright spot in the otherwise tumultuous US-China relationship. And some Chinese tech stocks have produced big gains for foreign investors in the last few years. But now, everyone's watching to see what steps Chinese regulators will take next.
我们要强调的是，中国坚持对外开放，支持互联网平台发展的政策没有变。
There is a sense maybe that the Chinese regulators were kind of blindsided by how severe the foreign reaction was. They don't want to completely close the door on the outside world, and they don't want to completely terrify markets, but they also are pretty resolute about what they feel they need to do, and they feel like this is all good for the long-term development of the Chinese economy. It seems like the campaign isn't over.